September 16, 1992, London, England. The British government is fighting for its economic life. The Bank of England is spending billions of pounds every hour trying to defend the currency. Interest rates have been raised twice in a single day, going from 10% to 12%, then to 15%, and none of it is working. Because on the other side of this battle is a Hungarian-American hedge fund manager named George Soros, who has placed the largest bet in financial history, in $10 billion, wagered that the British pound will collapse, and by the end of this day, he will be proven right. Britain will surrender, the pound will crash, and Soros will make $1 billion in profit in 24 hours, becoming the man who broke the Bank of England. This is the story of how one trader with enough conviction and enough capital can defeat an entire country's central bank, how governments lie to protect their currencies until the lie becomes too expensive to maintain, and how Black Wednesday in London proved that in modern finance, belief is more powerful than reserves. If you want to understand how currency wars actually work, and why sometimes the most powerful governments in the world lose to speculators, hit that subscribe button and comment which financial battle we should cover next. Because what happened in London in September 1992 changed how we think about currency pegs, central bank credibility, and the limits of government power in global markets. 1990, the setup begins. Britain joins the European Exchange Rate Mechanism, the ERM, which is basically a system where European countries agree to keep their currencies within certain bands relative to each other. The idea is to create stability and prepare for a future single European currency. But there's a problem. Britain joins at a rate that values the pound too high, 2.95 Deutsche Marks per pound, and to maintain that rate, the Bank of England has to keep interest rates high, even though the British economy is weak and needs lower rates to stimulate growth. George Soros is watching this closely. He runs Quantum Fund, one of the most successful hedge funds in the world, and he sees the contradiction. Britain is trying to maintain a strong pound while its economy is struggling. Unemployment is rising. The housing market is crashing, and British businesses are suffering from high interest rates. But the government keeps insisting it will defend the ERM rate no matter what. Prime Minister John Major says the pound's position is non-negotiable. Chancellor Norman Lamont promises Britain will do whatever it takes. 1992, the economy deteriorates. By summer, Britain is in deep recession. GDP is shrinking. Unemployment is hitting 3 million. Factories are closing, and everyone knows the pound is overvalued. Businesses are begging the government to devalue or leave the ERM so interest rates can come down. But Major's government refuses. They've staked their credibility on maintaining the pound's value. Devaluation would be political suicide, admission of failure. So they keep promising to defend the rate. Soros sees an opportunity. He realizes the British government is trapped. They can't keep interest rates high enough to defend the pound without destroying their economy. But they can't admit the pound is overvalued without losing all credibility. And this contradiction means eventually they'll have to choose between defending the currency and saving the economy. And when that moment comes, the currency will lose. It always does. Early September, Soros begins building his position. He starts borrowing pounds and selling them short, betting that the value will fall. He's not alone. Other hedge funds and currency traders are making the same bet, but Soros is the biggest, the most aggressive, and the most public. He's building a short position of $10 billion, an amount so large that it represents a significant portion of Britain's foreign exchange reserves. And he's not hiding it. He wants the Bank of England to know he's coming. The Bank of England tries to fight back. They start buying pounds with their reserves, trying to support the price they raise interest rates, hoping higher rates will attract investors to hold pounds, and they make public statements insisting the pound will not be devalued. That Britain's commitment to the ERM is absolute, but none of it is working. For every pound the Bank of England buys, speculators like Soros are selling more. The pressure keeps building. September 15th, the attack intensifies. Soros and other speculators increase their selling. The pound is dropping toward the bottom of its ERM band. The Bank of England is buying billions of pounds worth of currency every hour, burning through reserves at an unsustainable pace. And everyone in the market knows this can't continue. Britain doesn't have infinite reserves. At some point, they'll run out of ammunition, and when that happens, the pound will collapse. That night, Chancellor Norman Lamont calls an emergency meeting. They've spent £15 billion in a single day trying to defend the currency. And it's not enough. The selling pressure is overwhelming. They have two choices. Raise interest rates even higher, which will devastate the economy, or surrender and let the pound float, which means admitting defeat and leaving the ERM. September 16th, Black Wednesday begins. The Bank of England announces it's raising interest rates from 10% to 12%, effective immediately. This is supposed to make holding pounds more attractive, stop the selling pressure, but it doesn't work. Soros and others keep selling, the pound keeps falling, so at 11 a.m. they announce another rate hike, from 12% to 15%. Interest rates have increased 50% in one morning. Mortgages are suddenly crippling. Businesses are panicking, and still the pound keeps dropping. Soros is watching from his office in New York. He's been on the phone with his traders in London all night, monitoring every tick, and he knows Britain is finished. They can't sustain 15% interest rates. The economy will collapse. They're going to have to surrender. It's just a question of when. So he tells his team to keep selling, increase the position, push harder, because the end is coming. 7 p.m. London time, Britain surrenders. Norman Lamont appears on television and announces that Britain is suspending its membership in the ERM. The pound will float freely. They're abandoning the fixed exchange rate they've spent billions defending. It's over. Britain has lost, and the pound immediately crashes, dropping 15% in hours, eventually falling 25% over the following weeks. George Soros covers his short positions. He's borrowed pounds at a high price, and he's now buying them back at a much lower price. The difference is his profit, and when the accounting is done, he's made approximately $1 billion in a single day. The biggest one-day profit in trading history. And the Bank of England has lost $27 billion trying to defend a currency peg that was always going to fail. The aftermath is brutal for Britain. Interest rates that hit 15% for a few hours devastated homeowners and businesses. Thousands of people lost their homes. The Conservative government's economic credibility was destroyed, and they would lose the next election badly. And Britain's relationship with European monetary integration was permanently damaged. They would never join the euro. The trauma of Black Wednesday was too deep. But here's the twist, that nobody expected leaving the ERM and letting the pound fall was actually good for the British economy. The lower currency made exports more competitive. Lower interest rates stimulated growth. And within a year, Britain was recovering while the rest of Europe struggled. Soros had forced Britain to do what it needed to do economically, even though politically they couldn't admit it. The lesson from Black Wednesday is brutal, and clear governments cannot defend currency pegs that contradict economic reality, no matter how much they spend, no matter how high they raise rates, no matter how loudly they promise. If the market believes a currency is overvalued, and the fundamentals support that belief, speculators will attack until the government runs out of reserves or political will, whichever comes first. Soros proved that in modern interconnected markets, a determined speculator with enough capital can defeat a central bank. Not through manipulation or cheating, but simply by betting correctly on economic fundamentals and having the conviction to put massive capital behind that bet. Britain was trying to maintain a fiction that the pound was worth 2.95 Deutsche Marks when the economy said it wasn't, and Soros made them admit the truth. The British government called him a criminal. They said he'd attacked the country, destroyed lives for profit. But Soros's response was simple. He didn't break the Bank of England. The Bank of England broke itself. By defending an unsustainable position, he just recognized reality before they did, and profited from their denial. And anyway, forcing Britain out of the ERM probably saved the economy from years of stagnation. Today, Black Wednesday is studied in every economics course. It's the textbook example of how currency pegs fail, how central banks lose credibility, and how markets eventually force governments to accept reality. Similar attacks would happen to Thailand in 1997, to Argentina in 2001, and to various other countries that tried to maintain currency pegs against economic logic. George Soros became simultaneously the most feared and most respected currency trader in history. Feared by governments who saw him as a threat to monetary sovereignty, respected by traders who recognized his analytical brilliance and nerves of steel, and his $1 billion profit from Black Wednesday would fund decades of philanthropy and political activism. Money taken from the Bank of England and redirected to democracy movements around the world. If you found this story valuable, subscribe and share, because the man who broke the Bank of England proved that in currency wars, reality always wins eventually. The only question is how much governments will spend denying it before they surrender. And sometimes the smartest trade is betting against institutions that insist they'll do whatever it takes when you know they can't.